Hello and welcome back. My name is Josh, and today I want to do a little bit of a market update. In the last couple days, this is the last 6 months, we can see the market's been up. In the last 5 days or so, you can see the market's down 4%. This is the Nasdaq. If you turn on CNBC or something like that, they think the sky's falling, things are freaking out. Yes, some companies are doing worse, but some are doing better. I always like, there's a good phrase, when in doubt, zoom out. How often is a 4% drawdown? It's pretty common. We saw one just in September. We saw a 7% drawdown, and look how quickly it took to get back up again. It took, another month or so. So this is not abnormal. I would expect more volatility. However, I'm still a soft buyer on the dip. I'm not loading money in, but things. If something does look on sale, I'm going to pull the trigger. And this goes back to, if I had to give a piece of advice, it's more about time in the market than timing the market. If you buy a good stock, you can weather all these ups and downs. You can't time this perfectly. And so if you just kind of hold, even on a year, you'd be up 29%. If you tried to time everything perfectly, maybe you sell and you buy and you sell and you buy, and you could miss a lot of these rallies. So that's why I try not to time the market. I try to just slowly always be buying. And obviously on a dip, I try to buy a little more than when it's going up. So that's just my 2 cents. Now, what is leading to this market pullback? So there's a couple things. And this maybe gets to another important lesson that in the long term, the key to getting great returns is investing in great businesses at good valuations. That's Facebook's, Google's, Apple's. These are amazing businesses that have done a great job of taking money and turning it into more money, whether that's building new products, hiring smart designers to develop code that maximize their profit. That's the best way in the long term. In the medium term, though, it's very much market based. So, when interest rates go lower, tech stocks go up. And we saw Zoom and companies like that skyrocket, also because of the pandemic. But, in general, low interest rate environment equals better for growth in tech. High interest rate environment, typically better for cash cows and cyclical. So and in a rising rate environment, it's also better for financial companies because financial companies like banks and insurance companies make a lot of their money on interest rates. So in the medium term, it sometimes matters more about what sector you're going into, which is why people use thematic ETFs. They can go in and out of, oh, I want financial companies. I don't really care which one's good or bad, but this industry will outperform over the next 6 months. So, how is really what I'm trying to do is say, how is the market changing and where are we in this? So, one thing, there's a couple things right now that are leading to the market being tamped down a little. So one is there are some interest rate fears and inflation fears. So one, inflation's getting very hot. It was at 5 or 6% in the last couple of months. And when inflation gets too hot, um, typically what happens is the government or the Federal Reserve steps in and increases interest rates. And that kind of slows the roll because when interest rates go up, it tamps down speculation, it tamps down rising costs because people don't want to spend as much when it's more expensive to borrow. So that kind of slows things down. Now, no one likes rising interest rates, but it's better than having the economy overheat. They often use the analogy of an engine that you want the engine hot, but if it gets too hot, it can blow. So they slow it down. They go down a gear. That's the raising interest rates to make sure that it doesn't blow the engine. So that's something that often happens. And when we actually look at the data, we can see obviously, here we go, we're at basically record low interest rates. So it'd be reasonable to think interest rates are going up from here. So that's one thing that's really leading to markets slowing down, as well as there's supply chain issues that have lasted longer than people thought. There was a really bad set of earnings recently. The Apple iOS thing actually had a really big impact. Apple, for those who don't know, changed their iOS to allow users to opt out of tracking, and that enabled data companies like Google and Facebook to have worse data on tracking. And when small businesses are trying to do their marketing, They want to make sure that their marketing dollars are being as effectively and efficiently spent as possible. And when they suddenly um, didn't have that tracking, they either slowed their spending or they spent the money less effectively. So they got less ROI on their marketing. Plus, again, supply chain issues, which means some people didn't even have things to sell because they were saying, hey, normally I have thousands of shirts that arrived, and now I'm getting only 100 shirts a day arriving from my suppliers, and so I don't have as much stuff to sell. So there's a lot of things that kind of have slowed things down, but a major one is interest rates, and I know I talk about it a lot, but it's because it is an important macro thing. And again, in the medium term, the macro environment has a massive impact on the market. Again, long term, invest in great companies. Medium term, look at the macro environment. This is why, you know, if you invested in, let's look at ARK. For those who don't know, ARK Invest is an innovation fund. You can see here that oh, when Corona hit and then we dropped interest rates and everyone was work from home and everyone was tech, this thing outperformed like crazy, up 300%. But since then, it's actually down 31%. So that's a pretty significant drawdown. Now, again, overall it's up, but there's a pretty significant drawdown. And meanwhile, if you look at financial bank ETF, let's look at, there you go. Let's just do this one, FTXO. FTXO. And we look at the last little bit. When did ARK stop doing well? February 12th. Okay, so since February 12th, the bank one is up 20%. So again, sometimes it matters more about your sector than individual companies. Um, that was just an example. I'm sure there's others. Counter-cyclicals probably did well, but if interest rates go up, I think the financials will do well because they make a lot of their money on interest rate spreads. So I personally have been investing more into some financial companies, and I do have a video coming out about that, which I will post in the next week or so. But so interest rates, I think they're going up. They have nowhere to go but up. They're at record lows. However, that being said, how much can we expect them to go up? And some people are very afraid that we're going to see a lot of interest rate hikes. And I want to say why I don't think that's necessarily the case. So we have here some interesting data. So this is US national debt as a percentage of GDP. So recently, it actually just crossed over 100%. That means if the GDP, gross domestic product, basically you sum up all the things that the US buys and sells versus the debt they hold, there's now more debt than GDP. Now, people often try to compare this to a person. Oh, imagine if you had more debt than you made. That's not a good analogy. These are countries. They're not trying to, so it's a completely wrong analogy. If you ever hear that, just shut it off. It's not good. However, 100%, so over 100% has typically been kind of a death knell for a country. Japan did it a while ago, and their economy has been going down since then. And so a lot of people see this magical, GDP crossed, or sorry, debt crossed GDP. That's really bad. However, that loses a lot of context. Having 100% of your debt at 1% debt is probably better than having 80% of the ratio debt to GDP, but paying 50% interest rate. I know that's an extreme one. No one's paying 50%, but you get the point. Is it matters how much the interest rate is on that debt. If we scroll down here, as I said, interest rates are at an all-time low. So if we actually look at interest payments, this is how much interest they're paying on that debt compared to a percentage of the federal budget. We can see that it's obviously moved around a lot, but since the 50s, 50s to 80s was basically around 7.5%. Then it shot up 80s to 2000s. It was at almost 15%. Then again, we had and you can see here the similar kind of high interest rate environment. The interest payment shot up, low interest rate environment shot down, and obviously it did spike recently because we issued more debt, or the US issued more debt, but it's still not that much higher than the average. I'd say the average is probably around 8-9%. Depends when you start from, but let's say it's 9%, 10%. This is about average actually. So right now our interest payments are low. However, so right now the debt's not the debt that the U.S. has is not going to kill. However, if interest rate payments are to go up, because there is more debt now than there used to be, each incremental increase in interest rate is going to have an even bigger impact on how much of the budget it takes up. So if, let's just say 50% of your GDP, you had a 50% rate debt to GDP, and it went up 2%. If you have 100% debt to GDP and it goes up 2%, it'll have twice as big an impact on how much you're paying out. So a lot of people think that the Fed actually might not be able to raise interest rates too much, because if they do, it's going to take a huge chunk out of the federal budget. And if it goes from right now 9 to, let's say, all the way up here to 15%, as you can see, that's $150 billion. So that means that the budget, all your tax money, uh, again, right now, of all your tax money, 8.7% just goes to pay interest. That's it. It's just paying interest. If it goes up more, that means you either have to, one, collect more taxes. No one wants that. They are trying to find ways of collecting more taxes, either from corporate tax or from the super wealthy. I don't think it's going to happen. So the other option is they have to cut programs people like whether it's you know less funding for schools or for healthcare initiatives, or there's public transit. There's lots of things. So the only options are cut projects that people like or raise taxes. Neither one of those is very feasible, and especially in the political climate that the US is in, I think it's going to be very tough. So I think there's going to be a lot of pressure on the Federal Reserve to not increase interest rates too much, because if they do, um, it's going to lead to some major issues for the politicians. Oh, we have to raise taxes or cut funding. So, and those are really their only two options. They have no other options. So I think there's going to be a lot of pressure to ask the Federal Reserve to, yes, they need to increase interest rates, but a little. So I think interest rates are going up, but I personally don't see them going up too much, especially to historical levels. If we look at where they were, years ago, up to 20%, that's never happening again. I actually don't even think 5%. I think we're going to see it a 1 to maybe even 1.5% increase from where we are today, but I don't. That's, I think, at the high side. I think we're seeing 1 to 1.2% increase. Not, sorry, 1.2% additional, not increase. So I think interest rates are going up a little. So I think the markets are going to be fine. I do think that there's pockets of the market I want to be in more than others, and I think I want to be more diversified than I used to be. I'm far too heavily invested in tech. I'm trying to invest more in financials. I'm trying to invest more in companies that do well in inflationary environments in case inflation stays hot. So, some people are saying that's Visa. One way to look at Visa is, they basically take a percentage, a cut on all spending. So if all fees go up, if everyone increases their prices 5% and everyone still uses Visa, like their credit cards, then theoretically Visa should make 5% more because prices went up. So things like that. I'm really trying to find ones that will work well in all kinds of environments, because I do think that we're going to see much more rapid change in the macro environment in the coming years. I think we're going to see more, we saw kind of with COVID, we saw, look how quickly this crash was and then how quickly it returned. I think we're going to see more things like that, where there's going to be extreme events that happen in shorter periods of time. And so I want to have a portfolio where, if something does crash 50%, something else might be up 20%, and I can sell from the thing that's up to buy into the thing that's crashed. If everything's correlated and your whole portfolio crashes 50%, what can you sell to do more buying, right? One of the reasons I could do well here is I think I had a couple businesses that actually didn't do too poorly during this crash, and I was able to sell those to buy some companies on the cheap. So, and I also had some cash on the sidelines, or cash like equivalents. I think I was invested in like a bond ETF, And I also had some gold ETFs that did okay during that time. Unfortunately, I bought in gold again later. But long story short, you want to be well diversified. That's again, it goes back to basics, well diversified, so that in any environment you have things that are doing well that you can use to sell to buy better things if something else crashes, and things that are maybe not going to do as well. Again, long term, I'm still invested in tech, still invested in growth, but I do think that we're seeing more rapid changes in the macro environment, and so expect a bumpy road up ahead. Thanks so much for listening. Let me know, what do you think is going to be up ahead? Again, I still see this up and to the right. I still think the stock market's going up. I just think we're going to see different pockets do well. But let me know what you think. Thanks very much for watching, and talk to you next time.